What up, what up, what up, and welcome everybody. Welcome back to Pnoid News. Man, listen, we gonna hop back up on our economic shit today. I'll be honest with you. Look, all right, there's gonna be things that are gonna happen after the coronavirus, and I want y'all to be prepared and understand exactly what's coming, right? Because like there's a lot of stuff that I don't feel like individuals understand. All right. So first things first, let's get started with Walmart has announced it's not going back to 24 hours. All right. It's never going back to 20, like in general, like it's just not, like, period. Even once the coronavirus is over, it's not going back to 24 hours a day. Now, I got this article here. Walmart's extending stores hours. Here's why. We can call it a step forward back to normal. Most Walmart stores have been staying open later recently, but the retailer decided to close early back in March due to COVID. Most opens for Walmart were around the clock, but COVID has changed everything having to do with shopping. Many businesses closed their doors. Essential operations such as Walmart could remain open, but the company, along with other retailers, decided to limit their hours. Walmart announced on March 18th its U.S. stores will only be open from 7 a.m. to 8:30 p.m. Now, here's the thing, right? They're going to stay open till Walmart is not back to doing 24 hours, not back to store business 24 hours a day. Right. But it is going back to like 10 p.m. And here's what's going on. So the important thing to understand about this legitimately, right, is to understand that it is not going to go back to 24 hours ever again. Right. And what they're going to do is they're going to do the same thing they did with the self-serve kiosks. Right. And this is something that legit, like, everybody should be fully aware of and understanding. Right? It's really simple. They're going to tell you you're going to come at a certain hour during a day to buy your goods, and then that's going to be it. Because they lose money overnight. All right? They make money, but they don't make enough money overnight to justify it long term. Like, it's not enough to be able to offset the costs of doing business 24 hours a day. Right? Especially with them losing ground to places like Amazon and online retailers, things of this nature, especially with this COVID. Now, I mentioned that, that 24-hour kiosk thing, right? And this is an important thing to understand. So with the kiosk thing, where you say, we all used to be like, oh man, what, I got to stand here and scan my own groceries? Yeah, because it's faster. You're literally faster at scanning groceries than that bro who usually does it at the, at the checkout. So this here is from Restaurant Drive. 37% of operators plan to reduce labor costs with tech. Sorry, man, I had to pop up. Now, listen, my computer just did like 18,000 updates. 43% of restaurant operators plan to increase menu prices to combat rising minimum wage price increases and labor costs. This is from February 4th, 2020. Right. And 254 owners, operators, and executives of independent and franchise multi-unit restaurant companies. Labor-saving technologies such as self-serve kiosks and automated ghost kitchens will be used by 37% of those surveyed. Now, what you have to understand is this. And I'm setting up a picture for you. We're going to have much more automation, all right? And we're going to end up eliminating a lot of service sector jobs. And service sector jobs are a big thing, right? This is not like some small type of, niche market. This is a large market. In fact, the vast majority of the jobs added under Obama and Trump have been service sector jobs. They're usually the biggest hirers of everybody, all right? Because basically they feed off of the rest of capitalism's and the economy's ability to earn wealth. Right. So basically, as long as individuals have jobs, they'll go out and get something to eat, that type of thing. And well, that's no longer going to be the case anymore. All right. And you have to understand that these companies here, legit, the best are going to survive. The worst are going to kind of fall down and just be destroyed by all this nonsense. And it's not so much a part of it where you have to look at it and go, like all these individuals are being destroyed by bad laws. A lot of this has to do with the fact that there was a lot of money sloshing around in the system that has been screwing things up, in particular the 401k money. All right. And so the first of the boomers started retiring in 2011. It's an important ideology to understand. Okay. And so we are, over the next 10 years or so, going to see all of the boomers retire. And credit's going to get tighter and tighter each year. And we're about halfway through at this point right now. And things are getting super tight because individuals are no longer just looking for yield. They're actually pulling their money out of the system. And so what that does is that tightens up credit for the rest of us. Okay. I want you to understand, I've been saying this for a little while, probably not as loudly as I should, but the average credit score was like 790, all right, the past few years. And that's why everybody's, been able to get a loan. But guess what? With this coronavirus thing happening, everybody's credit's going to be destroyed. U.S. credit's going to be destroyed in general, and banks are tightening their credit, all right? So, this is from October 15th. All right. U.S. banks' third quarter reflected a decline in credit provisions and an increase in auto outstandings, tightening for credit standards and low delinquency and charge-off rates. U.S. banks' total provision for credit losses sat at $635 million in the third quarter, a decrease of $1.1 billion or 63.4% from the second quarter, indicating the bank is prepared for any potential credit deterioration to come. According to the earnings supplement, by comparison, the lender's second quarter was marked by a 43% increase from the first quarter in credit loss provisions. Auto also makes up 6.2% of U.S. banks' entire loan portfolio. Auto outstandings grew to $19.2 billion, a 2.6% increase from last quarter and a 2% decrease from the same period in 2019, when 96% of all of loans still originated through the indirect channels and 4% through direct. According to the earnings presentation, U.S. Bank did not break out origination volumes for the quarter. So, here it is. U.S. Bank's auto loans had a weighted average FICO of 794 in the third quarter, reflecting the lender's tightening of credit underwriting according to the credit's presentation. That's an important thing to understand, all right? It's really simple. If you don't have perfect credit and money down, you are not going to be able to get credit after this. All right. It's going to be very, very difficult. Legit. And in particular, it's going to be very difficult for a lot of companies that live on credit. That's something that, we don't have a lot of conversations about. Man, listen, I don't give a shit about your stupid thing. Right. All right. So, this is from CNBC. Banks say they are tightening lending standards even as demand for money falls. All right, so this is the deal. Banks are tightening lender standards across the board despite lower demand and as the Federal Reserve encourages lending. They said in the Fed, look, here's the deal. There's going to be a lot of saving going on. Legit. Like, this is what happens after a bad recession or a depression. In particular, if you look back to like the 1930s, the 1940s and 50s saw a massive savings rate. All right. Just a giant jump in the amount of savings in, households, banks, businesses, whatever the case was, because individuals saw how hard it could be and they wanted to make sure that they weren't caught with their pants down again. So banks are tightening lending standards across the board, even as they're being urged to get money to those who have been hit by the coronavirus pandemic, according to a Federal Reserve survey Monday. From commercial real estate to credit cards and auto institutions are getting tougher on giving out money compared with the second quarter, even though demand has decreased across most categories. The Fed Senior Loan Officer survey also found that the foreign banks are showing a reluctance to lend. Major net shares of banks that reported reasons for tightening lending standards or terms cited as less favorable or even more uncertain economic outlook, worsening of industry-specific problems, and reduced tolerance for risk as important reasons for doing so, the survey said. The banks further cited weaker capital positions, less competition, and worries over increased regulatory burdens. At the same time, demand for commercial and industrial loans ebbed, except for residential real estate. Demand fell for all other forms of consumer debt. So, really simple. People aren't spending money, all right? They're not going out and buying homes and cars and things of this nature because they don't have fucking jobs, all right? And because of the fact that your dollar continues to decrease in value, and because of the fact that we've had a lot of wealth eliminated here recently, it is what it is. You know what I'm saying? So where are we at? Where are we at? Well, understand something. We're going to go into a world that we haven't seen for a very long time. Okay. You think coming out of a depression, it'd be a boom. It's not going to be. All right. It's not how it works. You'll have an initial, oh, yay, everything's cool. Right. But like legit, I don't know if y'all heard about the K-shaped recovery. All right. What it is, like you have the big boys come down and go up. Right. And then it's kind of like you lay the K flat on a straight edge. And then like everybody else kind of just stays the same. Right. Or goes downward. That's the K-shaped recovery. Basically, what it means is that banks and Wall Street and people who already have assets are going to do well because of the fact that they're printing money and devaluing the currency. Everybody else is going to end up losing their ass. This is pretty much the truth of the matter. Or if you're smart enough to invest, and take what you have and, risk it and do the things you need to do, you can make some cash during this time. But the truth is that most people are not going to be better off after this recession. And that's been the case for a long time. There was a K-shaped recovery in 2008, 2009 when it really comes down to it. The average individual did not get better. And as I said, the vast majority of, of actual jobs created were in the service sector. They weren't good jobs. And this is something that a lot of people don't understand. Like, working at Uber, working, for, DoorDash, going out, working for Amazon. These are not family sustaining wage jobs. They're just not. Right. And that they would have been 20 years ago. Legit. But the problem is that we've destroyed the currency and brought too many people into this country. And we drove up the cost of living, and while at the same time destroyed the value of the currency. So the individuals on the top, they're going to make money. Like, it's not a criminal thing. This is math. Like, it's really simple. If you have stuff, your assets are worth more money. If you stand here and end up having, your dollar become devalued because it just costs more dollars to buy it. It's that simple. They're not worth more fucking, like, actual, like, pieces of gold or silver. They're worth more in the currency of the realm, which is complete and utter garbage, or just pieces of paper you can wipe your ass with when it really comes down to it. But that's a fact of life. So, where does that leave us? Well, I'm just giving you information. You know what I'm saying? You do with it what you want. I want you to understand that this is not some malevolent act. All right? Individuals are automating jobs because capitalism, legit, this is important to understand. Y'all remember this. Capitalism does not generate wealth. All right? It generates efficiency. That's important to understand. It's something that most people have no idea about. Efficiency. Okay? Legit. So if you're going to be the most efficient at what you do, you're going to automate and you're going to use the technology at hand. And if that means destroying the jobs on the bottom in your company, you're going to do that because that's how you make more money. It's a math equation. It is what it is. All right. And you can stand here and go, oh, man, automation doesn't destroy jobs. It creates jobs. And no, it doesn't. It creates garbage jobs. And that's the problem. All right. Legit. You can't the more pressure you put towards, higher end or middle and higher end jobs, the less that money's worth because there's more people competing for those jobs. It's that simple. Again, math. Math argues against everybody who tries to argue with math. It's. I get so tired of people going, oh, man, these people are Luddites. Feel you, right? But on the same point, if you don't have individuals able to buy stuff, it is what it is. I say we should probably be growing our own food at this point. We should be preparing for these type of things. I have not heard one government official come out and go, hey, maybe y'all should garden, right? Like, this shit started in March. Like, hey, maybe y'all should garden, like buy seeds. Feed yourself. Things might get thick. Not once has this been said throughout the entire thing. Because, legit, if they sat here and told you, hey, look, you need to take care of yourself. All right? Prepare. It'll be a whole different ballgame on the other side. Because this is America. And that's what we're really about. Anyway, look, Tom Peace with Pnoid News. You know the deal. Like, share, and subscribe. Peace.